Welcome, and thank you very much for joining us today. Times of conflict inevitably bring up feelings of uncertainty, and even more so when that conflict takes the form of a large-scale military invasion of Ukraine by neighboring superpower Russia. We've heard many concerns and questions from our clients over the last 2 weeks and wanted to offer you the chance to hear from Arthur Heinmaa, our Chief Investment Officer. Today, Arthur and I will have a conversation inspired by many of your questions. In recognition of your participation, we have made a donation to support the ongoing humanitarian efforts in Ukraine. Once we talk through some specifics, I want to end our conversation today with arguably the most burning question, which is how are portfolios positioned to withstand this climate? I hope you'll stick around to hear Arthur's thoughts on this. We promise to have you out within a half hour. Arthur, let's get started. We know this is an uneasy time for everyone. Broadly speaking, how should investors approach times of conflict and uncertainty?
Thanks, Ethel. I've been looking forward to speaking to everybody about these issues. And I think as a starting point, I'd really like to focus on emotion. I said it's important that we give voice to that and say that it's an emotional period and acknowledge that, because without acknowledging that, it can lead to poor decisions. And that's why it's important not to make dramatic changes in your portfolio right now. Don't make big changes in your asset mix. Instead, because that's exactly where investors go astray in environments like this. They get overly emotional about it. They say, let me just go to cash and wait out things. And so that's generally the wrong decision that you're going to make. The second point I'd like to make is that as we continue to watch the news, we watch the financial market news, we're on Yahoo Finance, we're on Bloomberg, we see all the numbers change. Remember, you're not buying a number, you're buying a business. It's very important that you remember that you're actually buying a business. And what underlies that business is your proportional ownership in those cash flows, your proportional ownership in that balance sheet, your proportional ownership in the intellectual property that's there, the brand, and your proportional ownership in those future cash flows that are going to compound to you over time. Third, don't trade the headlines. That's the worst thing that you can do, is that you can look at the headlines and say, oh my gosh, oil's up $20 today. I really should go buy some oil stocks today. So that's what leads you astray, in any market, is by not doing your homework and trading the headlines. And finally, tied to the issue of acknowledging an emotional time, it's mental preparation. Walk through what it's going to feel like if the market goes down another 20%. What would you do? Like, what are the opportunities that present themselves? That's exactly what we're doing here in terms of preparing our portfolios and looking for investment opportunities, so that we know if interest rates move, if there's a big move in oil prices, if there is a big move in the market in general, we know exactly what we want to buy, what we want to sell, and how we're going to position our client portfolios.
I like this idea of not being emotional, not trading the headlines. I think we can all really easily fall into that pattern. And so, over the last while, a headline we've all become familiar with is rising inflation. In the context of this conflict, this has been cause for some debate. I'm wondering if these recent events have changed your view on inflation in any way.
I think as far as inflation goes, the discussion of inflation is inseparable from what the central bank policy is going to be. And I think you really have to frame the inflation discussion also within central bank policy. Right now, the central banks across the globe are in a very tight spot. Inflation's been running hot, so they are in a position where they should be raising rates, but they can't raise rates at such a pace that they push the economy in the recession. And with all the economic stress that's going on in the world right now, it would be easy for the central banks to go too quickly and push the economy into recession. Indeed, you can even see that in the way the futures are pricing likely central bank rate increases. As little as 2 weeks ago, it was guaranteed that they would go by 25 basis points in March, and there was about an 80% chance that they go by 50 basis points in March as well. Now the probabilities are less than 100% that he'd even go 0.25%. So the market's already telegraphing that the economy is likely to be weaker, and how that plays out in inflation is still uncertain, because you have to differentiate between what is going to be structural or secular inflation that's likely to be sticky, and what is a one-time effect from the war that's going on. Our view overall is that over the next 18 months, that inflation will start to trend lower. Where it ends up still remains to be a question, but we do think that the trend for inflation over the next 18 months will start to move lower.
I think inbuilt in your answer, Arthur, is this concept of short-term versus long-term, and that those can be two very distinct things. And so when we think about the current conflict, there's no question that the human toll of war will have lasting impacts. At the same time, there are real business implications. So can you speak to what industries, both in Canada and globally, you think will be impacted on a go-forward basis?
Thanks, Well, that's a good question. And what here is an example where if you think really deeply, you think about what are the second order effects, what are the secular trends that are likely to remain in place long after this conflict has been resolved. And I'd certainly highlight three for sure. First being cybersecurity. I think that cybersecurity, what we've seen in terms of the attacks both back and forth, are going to be a key area of spending for businesses to protect themselves, for governments to enhance their ability in cybersecurity. So any businesses in the cybersecurity chain will participate for a long period of time. Secondly, is going to be defense. In a short period of time, you've seen Germany do an about face on its on policies that they've had in place since World War II, and announced increased military spending and increased commitment to 2% of GDP for defense spending for the foreseeable future. The same message is coming out of other European countries. And again, after seeing what's happened in Ukraine at this moment, you don't know if another Putin will arrive at some point, so the defense spending will continue. And third, and I think this is probably the one that has some of the greatest investment opportunities, is in the energy transition and renewables. No matter what government you're listening to, whether you're listening to Boris Johnson, whether you're listening to Germany, whether you're listening to France, there is all have increased commitment to renewables. Europe itself has moved up its target by 15 years to be entirely renewables. So that means there's going to be a huge amount of investment in the renewable sector over the next 10 years. And that's going to be a key piece of a key piece of protecting a nation. Remember, every other country in the world is watching what's going on in Europe, and they don't want to be subject to the volatility in oil. And it's just going to create a sense of urgency, not only in Europe, but countries throughout the world, to start to transition to renewables. And that will immunize their economies from the volatility that you've seen in the oil markets.
A trend I really hope not to see more of in the future is gas prices. Over the weekend, I filled up my car and saw a number on the receipt that I have never seen before. Can you speak a little bit to the implications for the energy industry in North America? And you touched upon this a little bit, but maybe you can expand upon what we expect to see from alternative energy.
The way to think about the oil industry is to think about it in the context of cloud cover. And the way we've thought about the energy and indeed other investment opportunities is that this conflict in the Ukraine, what kind of cloud cover is it given to governments and businesses to make different decisions? And one of the areas, certainly in energy, is that I think some of the environmental considerations are going to be pushed aside. It will be easier for oil companies to tap capital markets. There's going to be a political imperative for oil companies to find and get domestic oil to markets, both in Canada and the United States, that was not there 2 weeks ago. So it will be a good time in the short run. Oil companies will certainly profit from that. The second thing is that in terms of cloud cover, government policies can also change rather rapidly using this cloud cover. One is, I think we're going to see a big change in renewables. As I said, I think there's going to be an acceptance that we are going to have to continue to deal with conventional energy sources. And what I found interesting was that even the Green Party in Germany has acknowledged that nuclear is going to be a bigger part of the energy complex they have, that they're going to satisfy energy demands in Europe. So even in Canada and the US, I think the issue of nuclear can actually, is no longer going to be off the table. So again, that's going to be an opportunity for investment in engineering firms that service nuclear, the nuclear industry and nuclear reactors. And finally, in terms of cloud cover, is that I would not rule out that new pipeline projects wouldn't come on stream. Some that have been either mothballed or have been put on the sidelines. I said that they could certainly well be possibilities. And a way to think about this is that right now there are going to be, many of the companies are being priced for just for oil without any options on potential pipeline expansion. So that may be a way of getting some free options on some political decisions in the future. And that's some of the things you have to look at in this environment, is what kind of opportunities present themselves because they have this cloud cover from what's happened in the Ukraine. So you're not going to get the pushback that you would have just 2 weeks ago.
I'm sure that answer will sort of filter its way into our next question. And when we think about what's been happening out there, there's a lot of noise. It's hard to tune it out no matter how hard we try. You started out our conversation today by encouraging investors not to make emotional decisions. That being said, how can clients take comfort in their portfolio positioning at this time?
Because the root of the question people always want is that they want to know that they want to be all in cash when the market's going down and all invested.
Correct.
When the market's going up, and that's impossible.
And they want you to put it from cash to equities on the day that you're hitting the bottom.
On the day, and that's always impossible. But what you can do is, like, you can say, well, how do you stack the odds in your favor? And the way you stack the odds in your favor is that you invest along in a path that history and evidence has shown to generate success over long periods of time. And that means prioritizing companies with strong balance sheets, prioritizing companies that have strong cash flows, companies that have secular trends that they continue to accelerate the growth in those businesses. If you follow those, that over long periods of time, you're going to be successful. And where you're really vulnerable is where you start jumping between ideas. You say, well, energy is really big now. I got to buy energy. I got to buy anything connected to wheat, anything connected to copper, because they're all going up now. And remarkably, now everybody talks about commodities, and not a single person is asking about technology. 12 months ago, all we had was technology question after technology question, and now we have commodity question after commodity question. And that's what I mean. Where you can't trade the headlines. You have to think about the businesses and how those businesses populate a reasonable portfolio.
Those were some great high-level comments. When we saw the onset of the pandemic, Seidel was really quick to come up with the yield enhancement strategy, the credit opportunity strategy, to sort of take advantage of opportunities that we saw in the market. At this time, are there opportunities like that you see coming to the foreground? And can you also comment a little bit on what kind of activity has occurred within our strategies over the last 2 weeks?
Right now, we don't see anything that warrants specific attention. It's something we're always looking for, that may emerge right now, but right now there's not something where I think it deserves a special place in your portfolio or a specific opportunity. What we have done within our portfolios is a couple of things. First off, we've been identifying all those businesses that have those secular drivers that I outlined before. So we've looked for businesses that are in that cybersecurity value chain. We look for businesses that are in that defense chain. And finally, we are looking for businesses in the renewables and energy transition as being part of the portfolio as well, because we believe those secular changes will take place. The other thing we have been doing is that we have been preparing a list of companies that we want to be able to buy should there be additional pressure. Because what you're seeing is that companies are coming down in value, and it's a good opportunity to buy those strong cash flow compounding businesses at good valuations. So you're going to be able to upgrade your portfolio in terms of longer term expected returns at attractive prices. Because prior to today, what we saw was that that many of these companies just were always expensive, perennially expensive, but all of a sudden there's an opportunity to buy them. And finally, we continue to work on identifying any unique opportunities in whether they be in different countries or in different economic segments, so that we can continue to populate those in portfolios.
Thanks very much, Arthur. And thank you very much for being here today. If there are still lingering questions you'd like to discuss further, please reach out to your Sidel contact and they will be very happy to speak with you. Over the coming days and weeks, I know we'll all be glued to our TVs and reading the news. We're looking forward to a peaceful resolution in Ukraine. And in the meantime, you can be rest assured that we continue to keep a close watch on the markets and on your portfolios.
Thanks. I really enjoyed the conversation.